Hi everyone, my name is Emily Powell, Director of Marketing and Business Development here at Steigerwald, Gordon & Koch. And today is Friday, January 23rd, and it is my honor to introduce you again to our speakers of this episode. We have John Steigerwald and Eric Randolph. Thank you so much and hope you enjoy.
Good morning, everyone. My name is John Steigerwald. I am CEO and Portfolio Manager here at SGK Wealth Advisors.
And I'm Eric Randolph, Portfolio Manager and Certified Financial Planner.
So when I founded the firm 30 years ago, it was on the principle of being a fiduciary and being completely independent. What that means is we work exclusively for our clients. You want to talk about the fiduciary duty?
Absolutely. Charlie Munger once upon a time said, "Tell me about the incentives and I can tell you about the outcome." And I think that that's no more true than in the area of financial advisory. Unfortunately, there's a lot of options out there for investors to choose from, and they're not necessarily all equal as far as the advice that they provide. We're a fiduciary, which means that by law, we have to give advice that is necessarily in the best interest of our clients, even if it's not necessarily the best thing for us on our bottom line. I think at the end of the day, that makes a huge difference.
It sure does. A broker has to meet a suitability requirement. The fiduciary standard is an ongoing obligation to always act in our clients' best interests.
Absolutely. So this week, lots of excitement. As a matter of fact, so the Davos Confab. So I know there's a lot of stuff that went on, but what stuck out for you this time?
Wow. So late Sunday, Donald Trump threatened tariffs on our NATO allies, particularly European allies, unless the Danes gave us Greenland. Yet, as crazy as that sounds, that's what went on this week. So at the World Economic Forum in Davos, Switzerland this week, basically it was a gathering of world leaders. And fortunately, what happened was Trump backed off his threats. In other words, they entered negotiation with our NATO allies and European comrades and basically diffused tensions. So it looked like that was taken off the table, the tariffs. And fortunately, we had a rally in Tuesday and Wednesday, actually Wednesday, Thursday trading.
Wow. So, okay, I know that provided a fair amount of churning in the market, but that wasn't it. There was something else going on also.
Yeah, there sure was. There's been a popular trade, particularly amongst international hedge funds, called the yen carry trade. In other words, they borrow money in Japan at cheap interest rates, reinvested in U.S. stocks, U.S. even treasuries for the higher yield, or European securities. And it's been very profitable, very lucrative. It does involve leverage, though. There was a lot of volatility in trading Monday overnight in the Asian markets, particularly in Japan. They're having an election in February, so typical politicians are promising more spending, lower taxes, and it caused gyrations in the Japanese bond market overnight and a big spike in their longer-term yield. So that impacted global bonds. And here in the U.S., our 10-year Treasury in trading on Tuesday jumped about 6 basis points, which doesn't sound like a lot, but it was bumping up against 4.29%. And that's concerning because basically mortgage rates are based off of our U.S. 10-year Treasury. And we just gotten down to around the 6% level. So unfortunately, we're seeing a bit of an increase this week. And as of the time of filming this, fortunately, the 10-year Treasury is back down around 4.24%. So it's nice to see it settle back down. That helps sentiment again in Wednesday, Thursday trading.
None too soon. Too soon.
How about on the economic front, Eric? What struck you this week? We had some good news this week.
We did. None too soon. And on the economic front, so U.S. GDP growth for Q3 was actually revised higher to 4.4%. That's the highest rate we've had in 2 years. And the reasons why, what drove that growth was, number one, consumer spending. So that means if you went to the shopping mall trying to do your Christmas shopping, you probably saw the full sign on the parking garage. Also improved exports. Robust business spending, particularly in what area? You guessed it, AI-related infrastructure spending, right? Big surprise there. Also, inflation remained elevated but stable. It supports the expectations the Fed will actually be able to hold rates steady going forward. And also, jobless claims actually stayed low. So, overall, we actually had some pretty decent news.
Nice. And by the way, I want to assure our clients that neither Eric or I will be replaced anytime soon by an AI bot. So.
Thank goodness. So that said, we're earnings season. We're in full swing right now. What stuck out for you this week?
Well, we had a series of 4 companies actually released this week, and all positive. So I'll hit the highlights on a couple. Johnson & Johnson's been a long time SGK core holding since dating back to the financial crisis, and solid results this past quarter. They also raised their guidance for 2026 nicely. 2026 revenues are expected to be over $100 billion now. Some highlights, their med tech area, which is like surgical products, medical equipment, orthopedics, did really well. They grew revenues in that segment about 7.5%. Their international sales was a highlight. They grew 11% year over year for the quarter to exceed $10 billion, which we haven't seen before. Love J&J. It was a great stock for us last year. Their dividend right now is at 2.43%. That's about 110+% higher than the S&P 500.
I'll take it.
Yeah,
I'll
definitely.
take it.
We love dividends here at SGK. Travelers, another good dividend payer, had really strong results as well. The revenues grew about 4% year over year, but in particular, their adjusted earnings per share blew away expectations. It was over $11 a share, and the expectation was for $8.80. So they benefited there weren't a lot of catastrophes, thank God, last quarter. They're very strong underwriters, so their underwriting results were exceptional. Their investment income was better than expected as well. Travelers pays about a 1.62% dividend right now, which is over 40% higher than the S&P 500. One other highlight on that share buybacks, I talk about we love dividends at SGK, but share buybacks can be a powerful tool as well. They announced a $5 billion increase in their share buyback program. What that can do is enhance earnings per share results in the future because it reduces what they call the float, the number of shares publicly traded. How about Eric? Any highlights for you on the earnings front?
Got good news actually coming to you from the energy and infotech sector. As a matter of fact, spoiler alert, one of these is going to actually have a common theme you've heard before, as a matter of fact. So we're going to start with Kinder Morgan. Q4 profits actually and revenues actually exceeded expectations. Management highlighted structural demand growth through a couple of areas driven by what? Population growth, and then what? You guessed it, rising power demand from data centers, right? AI strikes again.
There you go.
AI strikes again. Also, we had CACI, ACI International. Q2 adjusted earnings per share actually beat estimates, though revenues came in slightly lower than expectations. However, full year earnings per share guidance was actually raised above consensus. So nice. There you have, hey, we're doing really good today. Our expectations are even greater for tomorrow. What more could you ask for?
Definitely. Both those stocks responded really well to earnings as well this week, which we, of course, like to see as well. So that's a wrap, folks. Thanks for joining us today.
And have a fantastic weekend. And as we say here at SGK, cheers.